Welcome back to Part B of Topic 6 lecture. This is where we will discuss the last three learning objectives 5, 6, and 7. In Learning Objective 5, we'll explain the notion of earnings quality and the factors influencing the quality of earnings. So, investors recognize differences in the quality of reported earnings numbers, and they consider these differences when they make an assessment of the implications of earnings reports for share prices. So earnings can be considered to be high quality when they are sustainable. Earnings that are generated from repeat customers and from high-quality products that enjoy steady consumer demand would be considered high in quality. In contrast, earnings that result from cutting back on discretionary expenditures are considered to be unsustainables. Now, these expenditures may be critical to creating future demand for the firm's products, creating new products, and developing competent management. But if these are unsustainable, they will be considered earnings with lower quality. So there are some examples like the gains or losses from debt retirement. This is obviously unsustainable. Asset write-offs from corporate restructuring and planned closings will also be transitory and therefore not sustainable. Also, profit increases traceable to temporary reductions in discretionary expenditures such as advertising, research and development, or employee training are also considered unsustainable. So when the earnings go up but it is sourced from unsustainable activities, then the earnings quality is said to be poor. But if the source of those earnings are considered to be sustainable, then the earnings quality is high. All right, let's move on to Learning Objective 6. We will understand here how stock returns relate to good news and bad news about earnings surprises. So let's look at these earnings surprises. The earnings capitalization model and the abnormal earnings model both requires estimates of future earnings. However, estimates can be incorrect, and therefore it could result to an earnings surprise. Let's have a look at these two examples, both occurring on the same day. The first example is eBay Inc. The online auction site reported fourth quarter EPS of 70 cents, 1 penny more than analysts were forecasting. So the announcement occurred after the stock market had closed for the day. eBay shares rose 2.4% the next day. Let's look at the next example, Northern Trust Corporation. This is a Chicago-based bank. They reported fourth quarter EPS at 69 cents when analysts had been expecting 75 cents. Northern's announcement came in the morning before the market opened, and by the end of the day, the company's stock had fallen 5.7%. So you'll notice the difference in the earnings that were reported is just 1 cent. 70 cents for eBay, 69 cents for Northern Trust Corporation. One is higher, albeit just 1 penny more than what analysts were expecting, but the other one is about 6 cents lower than the analyst was expecting, and it resulted in a much lower company stock, 5.7% compared to 2.4% increase for eBay. So here in figure 7.5, we can see the stock returns and quarterly earnings surprises. The gray area represents the good news scenario. This is where reported earnings are viewed as a good news earnings surprise because they exceeded the market expectation. Think of what happened with example 1, eBay Incorporated, when their reported quarterly EPS was 70 cents, 1 cent higher than expected. The second scenario here is when the reported earnings contains no news because they correspond to market expectations. So let's say that if eBay showed exactly 69 cents as their quarterly earnings, they will be perceived as no news. And the third scenario here shows that reported earnings are viewed as bad news earnings surprise because they fall below market expectations. Think of what happened to Northern Trust Corporation. So companies that report good news earnings, that is positive earnings surprise, tend to have an upward movement in stock price before the actual earnings announcement date, day zero in this figure here. And then this is followed by another stock price increase on announcement date. The stock returns for companies reporting bad news earnings surprises exhibit negative returns before the announcement, followed by another decrease in stock price at the announcement date. Modest post-announcement drifts in stock returns are also not uncommon, especially when the earnings surprise is quite large. So why do stock prices sometimes exhibit a positive or negative movement even before the earnings announcement date? Well, consider a company, let's say Ford Motor Company. Investors learn about automobile sales on a weekly basis and therefore they can estimate or anticipate fairly well the quarterly earnings number prior to its formal announcement by Ford. In that case, the earnings announcement to a large extent officially reports what investors already knew. All right, let's move on to learning objective 7. Here we'll discuss the importance of credit risk assessment in lending decisions and how credit ratings are determined. First, let's have a look at the traditional lending products. You might have heard of the common short-term loans, and these are the seasonal LOCs, the lines of credit. They are special purpose loans for temporary needs. Mostly, they are used for working capital requirements. They could be secured or unsecured. Long-term loans are those that mature in more than 1 year. They are most commonly between 2 to 5 years, and they are used to finance the purchase of fixed assets, the acquisition of another company, refinancing existing long-term debt, or permanent working capital needs. They are most of the time secured. Revolving loans, on the other hand, are variations on a seasonal credit line. The interest rate usually changes. It floats. That's why it's called revolving loans. Commercial papers are short-term notes sold directly to investors. They usually mature in 270 days or less, and the interest rate is fixed. And then we have the public debt. These are normally in the form of bonds, debentures, notes. They are like sinking fund and call provisions, and there are normally covenants attached to public debt. So when a company issues a public debt in the form of bonds or debentures or notes, they are actually directly selling to the public. So it's just like selling their stocks, but not in the form of equity, but it's in the form of a loan. So there are normally some covenants attached to a public debt. Let's look at evaluating the borrower's ability to repay the loan. This is the credit analysis that we're looking at in Learning Objective 7. So the first step is to understand the business and the industry. This is when the analysts look at the business model and the strategy of the firm and the industry as a whole. They look at the key risks and the success factors, as well as the intensity of the industry competition. In step 2, the analysts evaluate quality of earnings. So they spot potential distortions and they make adjustments for reported numbers as is necessary. In step 3, they evaluate the profit performance and the balance sheet strength. So this is where the ratios and trends are useful. They look for changes in profitability, financial conditions, or industry position. Then in step 4, they prepare a pro forma cash flow forecasts. This is where they develop financial statement forecasts and they assess the financial flexibility. Step 5, they perform due diligence evaluation. And they sometimes call this kicking the tires. You know, when you wanted to know if the tire is still okay and you kick it so that you know it's firm and it has enough air. That is what step 5 is about. Performing due diligence evaluation meant that they actually go and visit the company, have a look maybe at their factory, talk to their management, and do some due diligence of whether what is shown in the paper in financial statement is really what you can see in the actual office or in the actual facility provided by the firm. Then finally, in step 6, this is where they perform comprehensive risk assessment. The likely impact on their ability to pay will be looked at. They will assess the loss if the borrower defaults, and the loan terms will also be set. Now, credit rating agencies is in a sense dependent on the investor's beliefs. So investors' belief about borrower credit risk will influence the price paid and therefore the amount borrowed. The riskier the borrower, the less investors are willing to pay for the security. Credit independent agencies assess and grade the creditworthiness of entities that sell debt to investors. Credit ratings are letter-based grades, for example, AAA or BB or C, that express the rating agency's opinion about the default risk or the borrower's capacity and the willingness to meet its financial commitments on time and in accordance with the terms of the debt security. So the higher the credit rating, AAA, for example, is the highest, the lower the default risk. The lowest would be C, for example. So the lower the credit rating, C, the higher the default risk. So how does the credit rating process go? Well, the rating process involves more than just a detailed examination of financial statements, notes, and ratios. Each rating agency has teams of analysts who grill the corporate executives, meaning they ask them a lot of questions about the operating and financial plans, the management policies, the risk tolerance, and the firm's competitiveness within the industry. They also conduct a thorough review of business fundamentals. Credit risk can be adversely affected by organizational considerations like, for example, when firms are deemed to be aggressive in their application of accounting standards. The credit risk of a company can also be adversely affected when their financial statements lack transparency to business fundamentals. In the United States, there are three major credit rating agencies that assess companies' performance. Moody's Investors Service is one, Standard & Poor's Corporation is the second, and the third is Fitch Inc. Let us have a look at Standard & Poor's credit ratings in Exhibit 7.4. You can see the ratings as shown in the first column, AAA, AA, A, and BBB. These are the investment grade that has a strong credit quality. So extremely strong is AAA, followed by very strong AA and strong for A. BBB is not too bad. It has adequate protection, and the historical default rate is shown in the third column here. As you can see, when your company is rated AAA, your default rate is less than 1%. If, however, the company's credit rating is CCC or CC or C or even D, that's in default, then your company is not getting a good credit quality. The default rate for companies in the C investment grade area is more than half. That means 53.38% default rate. Let's look at financial ratios and debt ratings. Now, credit analysts use financial ratios to measure the profitability in terms of return on capital, the extent to which operating earnings exceed interest costs, that's the EBIT, interest coverage, and the EBITDA, interest coverage. So EBIT is just your earnings before interest and tax, and EBITDA is your earnings before interest, tax, depreciation, and amortization. They also measure financial structure, that is the total debt divided by the capital. They also measure the cash flow capacity, which is the funds from operations divided by total debt, or the free operating cash flow divided by total debt, and total debt divided by EBITDA. Now, each ratio's median value for U.S. corporate borrowers in each rating level is used for comparison. So you can see in Exhibit 7.5, Standard & Poor's key financial ratios and ratings of corporate debt. So the AA, for example, has about 13.6 EBIT, interest coverage, and total debt over capital percentage of about 34.8%. Whereas a CCC rating will have only 0.4 EBIT interest coverage and 101.2 total debt to capital percentage, and all the others are provided there. All right, let's now go to Appendix A. Here we will illustrate how the discounted free cash flow, DCF, and the abnormal earnings valuation methods are used to value a business opportunity and to determine the value of a company's stock. Some background information here. We have Alan Ford, who is thinking of opening his own independent coffee shop, but he rejected the idea of opening his own, and he considered affiliating with a national or a regional company. So he decided to be a franchisee. After investigating several possibilities, he settled on By the Cup. This is an expanding regional chain of franchise coffee shops. So we will look at first Exhibit 7.6, which shows the valuation of the By the Cup franchise using the expected future free cash flows. So we have here years 1 to 5 and years 6 to infinity. The sales that is expected for year 1 is 200,000, year 2 250,000, and so forth and so on as given there. Then we have here the royalties, the depreciation, the amortization, and other operating expenses as projected. And the pre-tax income for year 1 is 13,300. For year 2 is shown there at 18,300, and so forth and so on. We can see that after all royalties, depreciation, and amortization, and other operating expenses, the pre-tax income is looking quite good with kind of a steady growth or increase every year. Once you've calculated the pre-tax income, we'll need to add back depreciation and amortization in order for us to reach the free cash flow. So that is what we are doing in this part here. Depreciation and amortization of 2,500 plus 4,200 is 6,700, and so we are adding that back to the pre-tax income to calculate for the free cash flow. Now, there is also something that we need to note here in this illustrative example. The working capital is supposed to be deducted because there are inventory additions that will happen from year 2, year 3, year 4, and year 5. So the inventory additions for year 2 and year 3 are 5,000 respectively, and so we'll deduct that from the pre-tax income before we can calculate the free cash flow. For years 4 and 5, the inventory additions are 2,500 each. And so we can see here the free cash flow, 20,000 for years 1 and 2, 25,000 in year 3, 30,000 in year 4, and 32,500 in year 5. We can also see that from year 6 onwards, the expected free cash flow is 32,500. So we're going to multiply those free cash flows by the present value factor. But before we go through that, remember in year 6, we are not just looking at 1 year here. We are looking at year 6 to infinity. And so the best way to calculate the future free cash flows from year 6 onwards is really to divide that by the discount rate, which in this case is given at 16%. So 32,500 divided by 16% will give us 203,125. So we are expecting that the free cash flows from year 6 onwards will be 203,125. So now we can multiply this by the present value factors. Because the discount rate is 16%, we can calculate the present value factors as 1 divided by 1 plus r to the t power. So in year 1, it will be 1 divided by 1.16 to the first power, and that should give us 0.86207. We'll do the same for year 2 and so forth and so on. So once we have multiplied the free cash flow for each year by the present value factors, we will get the present value of the future free cash flows. And the total of that, once we total up these columns, we should get the total present value of these by the cap franchise, and in this case is 176,873. Let's move on to the next. How do we value the same business using the expected abnormal earnings? And this is what's shown in Exhibit 7.7. So we will start with the beginning book value of the business. And we are told in Appendix A that Alan Ford will be putting in an investment of $100,000 in year 1. Now, we have already calculated in Exhibit 7.6 the pre-tax income. So in year 1, the pre-tax income is 13,300. So remember that the beginning book value will be increased by the pre-tax income. So we'll add that 13,300 pre-tax income in year 1. But it will be decreased by the dividends paid. And we normally assume that whatever is the free cash flow will be paid as dividend to the owners. So in this case, in Exhibit 7.6, we have seen that the free cash flow in year 1 is 20,000, year 2 is the same. So we will be deducting the free cash flows in year 1, year 2, and so forth and so on. So our ending book value for year 1 is 93,300. Now we can compare this time the pre-tax income, which is 13,300, and the normal earnings. So what is the normal earnings? Remember that we use 16% as the rate. And so 16% times the beginning book value of 100,000 is 16,000. So when we compare the pre-tax income and the normal earnings, we will get the difference as the abnormal earnings. So it looks like normal earnings is higher than the pre-tax income, and so our abnormal earnings for year 1 is negative 2,700. So let's go to year 2. In year 2, our beginning book value will be the ending book value in year 1. So 93,300 is now our beginning book value. Then we'll add the pre-tax income, which we can see from Exhibit 7.6 to be 18,300. So we'll add that, and again we'll deduct the dividend, which is the free cash flow for year 2. And so we'll get the ending book value for year 2 at 91,600. So now again we can compare the pre-tax income with the normal earnings. So our pre-tax income for year 2 is 18,300. And what's the normal earnings? It's again 16% of the beginning book value of 93,300. And so we'll get 14,928. Now, when we compare pre-tax income from normal earnings, we get a positive 3,372, and that's our abnormal earnings. So we should just be doing that for the rest of the years. And because year 6, again, is not just 1 year, but kind of infinity, whatever abnormal earnings we get for year 6 will be divided by the discount rate of 16% before we multiply the abnormal earnings by the present value factors. So whatever is our abnormal earnings that we've calculated for years 1 to 5 and year 6 to infinity, we will multiply it by the present value factors, which should be the same as the one we have used in Exhibit 7.6. Because again, that is your 1 divided by 1 plus r to the t power. Once we have calculated the present value of all the abnormal earnings for years 1 to 5 and year 6 to infinity, we will be able to calculate the total present value of abnormal earnings, 76,873. And once we add the initial investment of 100,000, we'll get 176,873. Now, does that figure look familiar? Yes, that is exactly the same as what we got in Exhibit 7.6 when we use the expected future free cash flow as our basis for valuation. And by the way, that is what the business is worth. All right, so we will now go to apply what we have learned, and the first exercise that we'll look at is exercise 7-5. Here, we are looking at why price-earnings ratios vary. We are given here 4 companies, and we are told that they are all from the same industry. Ingles Markets, Kroger's, Sprouts, Farmers Market, Wise Markets are all in the grocery industry. And the question is, what factors might explain the difference in the PE ratios of these companies? So in general, price-earnings ratios are inversely related to risk, and it's positively related to growth opportunities and earnings quality. So it means that the higher the growth opportunities, the higher the price-earnings ratios. That's positively related. Inversely related to risk means the higher the risk, the lower the price earnings ratios will be, and vice versa. So these 4 firms, as stated, all belongs to the same industry, the grocery chain. So there shouldn't be a lot of variation in PE ratios among them. Now we notice that Sprouts Farmers Market has the highest PE ratio of 18.3. This company is relatively small, but it is rapidly expanding. So the analyst forecast of earnings growth over the next 5 years for this company is quite high. It is at 9.1% per year. You can find this analyst forecast if you Google them. Now compare that to Kroger and Ingles. Their growth is about 6.1% and 6.5% respectively. For Wise, there's no available estimate for 5-year growth. And so you can see that Sprouts Farmers Market has a higher growth rate, and that is reflective in the price earnings ratios. It is unlikely that investors assign substantially different risk to any of these companies because they are all in the same industry, and so they face similar economic conditions. The differences in earnings quality might also explain why the PE ratios of these grocery firms differ so much. However, within an industry, the differences in earnings quality may be less important as well in explaining the differences in PE ratios. Why is that? It's because firms in the same industry tend to use similar financial reporting practices. So in summary, it is likely that the investors believe that the growth opportunities for Sprouts is greatest. That's why the analysts view this company to have the highest PE ratio. All right, let's move on to another illustrative problem that we're going to discuss, problem 7-7. Here we are looking at determining abnormal earnings. So this is learning objective 1. As discussed in the chapter, the abnormal earnings are given by the formula X sub T minus R times BV. So X here stands for the firm's net income, R is simply the cost of equity capital, and BV is the book value of the equity at time T minus 1. So let us look at the first requirement. We are asked to solve the following problems. Number 1, if X is $5,000, the rate is 15%, and book value is $50,000. What is the abnormal earnings? So let us calculate. Abnormal earnings is equal to X sub T, which is given at 5,000, minus the rate of 15% times the book value, which is 50,000, and so we'll get negative 2,500 here. All right, so that's pretty straightforward. Let's go to requirement 2. If the income is $25,000, the cost of equity capital is 18%, and the book value is $125,000. What is the abnormal earnings? So again, abnormal earnings is simply $25,000 minus 18% times 125,000, so that gives us positive 2,500. So the company in requirement 2 obviously is doing a lot better than requirement 1 company. Let's move on to number 3. Assume the firm in requirement 2 can increase the income to 30,000 by instituting some cost-cutting measures. What's the new abnormal earnings? Our abnormal earnings will be calculated as 30,000 minus 18% times 125,000. There's no change in the rate and there's no change in the book value. So obviously we will be able to increase our abnormal earnings from 2,500 to 7,500 because of that increase in the income by 5,000 from 25,000 to 30,000. Let's move on to number 4. Assume the firm in requirement 2 can divest $25,000 of unproductive capital with income falling by only $2,000. So what is the new abnormal earnings? All right, so our abnormal earnings would be the $23,000 because it used to be 25,000 minus the decrease of 2,000. So that's 23,000 minus 18% times $100,000, because it says from 125,000 we're divesting 25,000, so we're decreasing it by 25,000, so it's 100,000 book value. So what do we get as our abnormal earnings? It's $5,000. So eliminating unproductive assets that do not earn as high a rate of return as other assets will increase the abnormal earnings. So in this case, the unproductive assets were earning a return of only 8%. How do we calculate that? It's the 2,000, the decline in the income, divided by the decrease or the divestment of assets of 25,000. So that means this asset that we are divesting is only earning 8%, a lot lower than the cost of equity capital, which is at 18% for this particular company. Let's move on to requirement 5. Assume the firm in requirement 2 can add a new division at a cost of $40,000, which will increase the income by $7,600 per year. Would adding a new division increase the abnormal earnings? So we can see from here, the calculation would be AE is equal to 32,600 minus the rate of 18% times 165,000, and that would give us 2,900. Again, we can see that the abnormal earnings increased by $400 from 2,500 to 2,900. Therefore, we can conclude here that adding the division makes sense. The new division earns a return of 19%, so that's 7,600 divided by 40,000, which is higher than the firm's 18% required rate of return. So therefore, it adds value to the firm, and that's why there is a positive change in the abnormal earnings. All right. Let's go to number 6. Let's assume that the firm in requirement 1 can add a new division at a cost of $25,000, which will increase their X sub T by $3,500 per year. Would adding the new division increase the abnormal earnings? Abnormal earnings will be equal to 8,500. That's the 5,000 plus the 3,500 now. So 8,500 minus 15% times $75,000, because there's an additional 25,000 in investment. So this would give us minus 2,750. So the abnormal earnings falls by another $250. Why is that? Adding the new division does not make sense because in essence, the new division does not earn a high enough rate of return to justify the investment. The new division earns a return of only 14%. If you divide 3,500 by $25,000, you will get 14%, and this is less than the firm's 15% required rate of return. So the value is lost and the change in abnormal earnings is negative. All right, let's now move on to our last illustrative example here, and this is problem 7-8. Here we'll apply learning objective 7. So in exhibit 7.5, we describe the key financial ratios Standard and Poor's analysts use to assess the credit risk and assign credit ratings to industrial companies. Now, these same financial ratios for three firms follow as shown in this table. So in exhibit 7.5, which I have reproduced here, we can see the different ratios for each of those ratings provided by Standard and Poor's. So the first requirement asks us what credit rating would be assigned to firm 1. Now we can see that firm 1 here has 2.7 EBIT interest coverage, EBITDA interest coverage of 3.7. So if you have a look at where does firm 1 resonate with, 2.7 is quite close to this, isn't it? The EBIT interest coverage for double B is 2.3, that's 2.7, pretty close. The EBITDA interest coverage is 3.7, it's here 3.1%. And if you have a look, all the other financial ratios are pretty close to double B. And so we can say that firm 1 is most likely to be given a credit rating of double B. Let's go to requirement 2. What credit rating would be assigned to firm 2? So let's look at EBIT interest coverage of firm 2, 12.8. That is pretty close to double A. All right, and their EBITDA interest coverage 18.7, pretty close again to 17.1, and even their total debt over capital percentage 30.2 is close to double A rating. So we can say that the financial ratios for firm 2 are closest to the median values for double A rated companies. Let's go to requirement number 3. Does firm 3 have more or less credit risk than firm 2? And how can you tell? Have a look at the EBIT interest coverage for firm 3, 16.7. So that is more than double A, close to triple A. EBITDA interest coverage 24.6. Again, it's more than double A, close to 25.3. Even have a look at return on capital. 32.7 for firm 3. Again, if we compare that to AAA rating, 35.1, it's pretty close. So we can say that all the financial ratios for firm 3 tilt towards the median values for AAA rated companies. And so, consequently, firm 3 appears to have less credit risk than firm 2, although it is doubtful that this difference in credit risk is large enough to warrant a higher credit rating than that assigned to firm 2. Alright, so that's it for topic 6 lecture. I'd like to end by giving you a quote. It says, whether you think you can or think you can't, you are right. It actually points out again to how we value ourselves, given that God has made us wonderfully and fearfully. We should remember that in the eyes of God, we are truly valuable. Despite what others say about our value, we know that we are valuable in God's eyes. So whether you think you can or you think you can't, you are right. In Philippians chapter 4 verse 8, the Apostle Paul actually says this, finally, brothers and sisters, whatever is true, whatever is noble, whatever is right, whatever is pure, whatever is lovely, whatever is admirable, if anything is excellent or praiseworthy, think about such things. think of all the good things that God has made for us and made us very, very valuable. Let's end with a word of prayer. Gracious Father in heaven, in topic 6, we have learned a lot about business valuation, and we know that analysts truly put a value on firms by making those calculations. And we know that in one way or another, we too judge others and ourselves sometimes according to the worldly standards and worldly measures. But we know, Father, that you have created us and you've made us so wonderfully in your image. We pray that our value of ourselves will truly reflect the value you have given each one of us. And that is, you have given your only Son, Jesus, to save each one of us because we are created in your image. We pray, O Lord, that we will fully surrender our all to you so that you can use us mightily. In Jesus' name we pray. Amen. All right, so that's it for topic 6. Don't forget your post-lecture required activities, and I'll see you shortly in class. Bye for now.